Welcome to Market Profile Nuance 13. Today we focus on fade versus follow, when it is too early to fade. Our goal is to understand the difference between a market that is still building initiative and one that is truly ready for a reversal. Many traders try to fade too early, trading against the move before the market's initiative is actually exhausted. In this nuance, you will learn how to identify when a fade is premature and why a weak pullback does not signal the end of a trend. We will distinguish a full breakout from a mere poke and pull, and learn to read tempo as a signal of dominance. When the market breaks a key level, like the value area high or the initial balance high, traders often expect one of two things. They either expect a false break for a fade setup or an immediate return because the market has already moved far enough. But auction logic says otherwise. As Jim Dalton notes, the market doesn't have to return. It can continue because the other side is simply not present. A reversal expectation is only justified when the market actually fails to continue its initiative. Remember this: absence of rejection does not equal a fade, and continued initiative is not the same as being overextended. Let's look at why it is often way too early to step in front of the market. Imagine a break above VAH. The price slows down and a small pullback appears. The trader immediately goes short. But the reality is that the market isn't finished. That pullback is a natural part of the initiative process. In this case, the fade is premature and weak. You are trading against the dominant momentum. Dalton explains that after true initiative comes the first pullback, not a full return to value. If you see buying absorption or price holding, the market is building a new consensus. To fade here is to fight the majority. Let's look at false signals. When price slows down after a break, it often means the market is just building value or waiting for more liquidity. If the point of control hasn't moved up yet, the auction is simply in the process of shifting. Dominance remains. A volume spike without a price reaction indicates absorption. The strong side is absorbing the counterpressure. And a small dip after a break, that is often the first pullback, an opportunity to join the move, not to fade it. Common signs that it's too early to fade include no strong rejection, price holding above the break, and a migrating POC. If the tempo hasn't reversed and there is no signal of initiative failure, the move is simply not finished yet. A fade only has an edge when the market has lost its initiative. Look for a lack of follow-through and a break in tempo. Valid fades occur when a break fails quickly or when tempo breaks and turns into rotation instead of a further push. In summary, fading without failure is a trap. Following continuation gives you the edge. Fade only when rejection is clear. As Jim Dalton says, fade based on the failure of initiative, not just price. Learn to observe failure rather than assuming it. Thank you for watching.